Yo, 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 my friends. What's good? This week, for our finance video, we're venturing into a bit of personal finance, okay? So for my first, I guess it's been 3 finance videos now. We've sort of stuck to the stock market, picking an individual stock, reviewing the financial statements of that stock, and then revealing whether I feel like it's probably a buy or sell, depending mostly on the financials, how they look, how they're managing their money. And I got to thinking to myself, there's about 45 to 50% of the United States that's not invested in the stock market at all, right? And so that leaves about 50% of people that are, and even less, probably less than half of those actually invest in stocks that they pick. The rest are in their company's 401k, their state's 403b plans, et cetera, retirement. Somebody else chooses those investments. So very few individuals actually choose their own investments to begin with. But so I decided to take a little bit of a different path with that, with those statistics laid out. That means that 50% or more don't have the resources or the money to invest in stocks. So I figured I could talk about ways to get the money to invest in stocks, right? Like, I read a book called The Simple Path to Wealth, and this is sort of what this is modeled off of. And it works. It works. I mean, you can ask all professional money managers. This right here works. Okay? It's very simple. But these 5 bullet points and the 3 skills listed below will make you a millionaire. So let's get started. Number 1 is build your income and skills, right? I mean, that's obvious. You have to have skills. We live in a world where we have a lot of entitlement. If you want to get paid a lot of money, you need to have high-level skills. You need to have a skill that not many people have, or you need to have a skill that companies or individuals are willing to pay for. You don't just get paid for existing. Okay? That's not real. You have to build skills. You have to provide value to the planet in some way, shape, or form in order to get income. So you have to build skills to produce income. For me personally, I could use myself in that example. Accounting and finance are my skills. That's what produces. I felt as an adolescent that was what would produce the best life for Justin. I thought that was what my brain was capable of, that would produce the best life for me. And it goes, you can be a welder, a plumber, an electrician. It doesn't have to be white collar, right? Electricians and plumbers get paid really well. You don't have to work in the white collar world to follow this simple path to wealth. You can have any job, any skill, as long as you have income. You build your income. Every year, focus on making your income, if not a lot higher, just a little bit incremental. Higher. Slowly but surely. Build your income, build your skills. Stay focused on that month after month, year after year, and your revenue will grow. The amount of money coming in will grow. Now, usually, most people assume that number 1 is the most difficult bullet point. They think that building skills and building income probably the hardest to do. False information. Okay. Number 2. Okay. Cut and manage your costs. Quote unquote, live below your means. If you've ever heard that. Okay. So this is the hardest, most difficult step in this entire simple path to wealth, we could call it. Okay. Very, very hard. Takes a lot of discipline, it takes a lot of consistency, and it takes a lot of vision. All 3 skills needed to follow this path to stick to number 2. We have the average person in the United States makes about $50,000 a year. The average person. So for those of you who think, if you're younger watching this, if you're an adult, you already know. For those of you who think that you'll be making a lot of money when you're an adult, it's unlikely. Very unlikely. The averages are not in your favor. You will have to build your skills past the average person to exceed an above average income, my friends. So that was what makes number 2 most important. The average income is $50,000. Most people don't make a lot of money. They make a decent amount of money, we could call it, okay? So number 2 will be huge. You don't want to live in a house that you can barely afford. I have subscriptions up there as a note because this is a huge deal for us. All the subscriptions that we buy modern day, Amazon Prime, okay, Spotify, okay, YouTube TV, okay, and I personally have YouTube TV. That's my only subscription, right? My only subscription, but I'm just adding that one in there. DirecTV, Dish Network, etc. Whatever. I mean, internet, all this stuff that we have to pay for that are subscription based. We pay a monthly fee every month to have that service. You would be shocked at how much money you spend on a monthly basis just on subscriptions if you're an adult. You should break that. That's the first place you could look when it comes to cutting and managing costs, is the subscriptions that you spend your money on. You want to limit those as much as possible. And, you should never, a good rule of thumb for point number 2 is that you should never be break even. Okay. Growing up, my grandpa taught me the basics of finance, and I had no idea as a kid. Okay. He taught me, and I had no idea at the time. But really, if you spend more than you make, you're screwed. If you spend less than you make, you'll always save. Mind-blowing. Okay. But that's extremely difficult to do in real time. There are opportunity after opportunity for us to spend money for things that we want, we desire. And for the most of us, we do not have the discipline to stick to keeping our costs down, right? We always want these nice new things. Every human being that exists wants the nice new shirt, the nice new socks, the nice new shoes, the nice new TV. Every human being wants the nice new everything for the most part. And you have to discipline yourself to tell yourself for at least some extended period of time, several years, that you're going to live below your means, okay? And honestly, it should go past several years. Spending less, you should always spend less than you make. The only time in a month's period that you should spend less than you make, okay, is if you're making huge, like you're taking risks. You're making big investments, and they're not going to last forever. The outflow of cash just making you break even will not last for 6 to 12 months, right? You need that to end. You need to be operating on a net positive every single month. And I know that some people don't have a lot of income or skills, right? And so their income gets completely taken by their bills. We go back to point number 1. You have to build your skills. You cannot be entitled or ignorant to the fact that you are not as skillful, potentially, as the next guy or the next woman. There are 8 billion other human beings on the planet that are high-skilled individuals. Okay? We all have the capability of building skills. If you want more income, build your skills. Okay. So that's pretty much it for number 2 for cutting your manager costs for 1 and 2, right? Spend less than you make so that you have a surplus money that you have not spent at the end of every month. You can consider yourself a net saver. So let's move on to number 3. When you become a net saver, this is when you want to start buying assets and managing or limiting your liabilities. What I was saying when I was saying that you could be break even with number 1 and number 2s for several months. If you've bought an asset that will increase your wealth, and you've used debt to finance it, aka a house, it's completely fine to be break even for a couple of months until you get things worked out. Now, if you're going to purchase that house and your income will never supersede the cost of that house and you'll be living break even every month, then that's an L. You don't need that house. You only need to buy a house that you can afford, right? Even if that's less house than you envisioned in your entitled brain that you should have, okay? Straight up. If you can't afford it, don't buy it. But, I say manage liabilities, and that's a big but, right? The only liabilities that are acceptable in the wealth world is a mortgage or something related to a business, investments, okay? Your car payment, you don't need. Okay, your second car payment, you don't need. Straight up, okay? You just don't need it. All the other little payments, the UTV four-wheelers that people buy and buy on payment that's like a car payment, you don't need. You know what I mean? You need to you need to buy assets so that one day you can buy those pieces of equipment straight out. No liabilities, no payment attached to it. Right? You own an asset. You own an asset with no lien, and you own an asset with no liabilities, no money that you owe for it. Instead of where most people buy assets and immediately have a liability attached to it. So they buy a $10,000 car and they have a $10,000 bank note that they have to pay back. You want to buy a $10,000 car and owe the bank zilch. That's the goal. So the only liability that you should have is a home. And to be 100% honest with you, if you have done numbers 1 and 2 successfully, and you've gotten to number 3, and you've purchased assets and managed your liabilities, you will be able to probably pretty comfortably purchase a home and keep that home for however many years and be able to pay that home off in a lot shorter period of time than you would keep that home. So the normal home be 30 years. If you've done steps number 1 and number 2 well, you'll be able to pay that home off in at least 20 rather than 30. You'd be able to pay it off quick if you so chose. So no liabilities or limited liabilities, only to the mortgage or investment business decisions, whatever you want to call it. Business loans that are going to make you money. Leverage, we could call it. That moves us on to number 4. So number 4 sort of goes with number 3, but I decided to separate them because number 3 I sort of saw as like physical, tangible, house, car, clothes, all this type of stuff you can buy that you can hold, right? That you can hold. So for number 4, you want to invest into the S&P 500. So when you have a house that you live in, that every single month you're paying for comfortably, you have little to no liabilities, you can start investing consistently. So all the money that you had tied up in car payments, et cetera, the UTV, ATV payment, okay, whatever, the lawnmower, whatever, all the money that you had tied up in the payments, you will start investing into the S&P 500, which is effectively like retirement. You can go to Vanguard, Fidelity, BlackRock, all the major investment firms, pick a ETF, an exchange-traded fund or mutual fund that tracks or follows the S&P 500 and start investing the same amount that you spend on your car payment. Let's just say $200 for an example, which is actually cheaper than every car payment almost these days. But let's just use $200 as an example. You've paid off all your debts. You have a home that you're living in. You have $200 a month free that you were paying into debt. Prior to paying off all your debt, you want to immediately, the month after, start putting that $200 into a mutual fund that tracks the S&P 500, and you want to use dollar cost averaging. And dollar cost averaging means investing the same amount every single month, regardless of if the market is up or down. So if the market went way up this month, the S&P returned 25%. It went huge in 1 month. You're going to send $200 anyway. If it went down 25% in a month, which would be damn near financial crises, you're going to send $200 a month. That's dollar cost averaging. Every single month, after you've paid off all of your liabilities, you're going to start investing into the S&P 500 or something that tracks it. And then for number 5, patience and time equals wealth. So when you've started investing to the S&P 500, and I use this as an example because this is the simple path to wealth method. Like I said in the beginning of the video, disclosure, the majority of folks do not pick their own stocks. It is too difficult to beat the S&P 500 over the long term. The S&P 500 on average, will return you 8 to 10% a year or more, right? I mean, it is going to be hard to beat that by picking random stocks unless you get lucky. Professional investors all around the world struggle to beat the S&P 500. Okay, all around the world. Even Warren Buffett himself struggles to beat the S&P 500. Although he does a lot, it's difficult. Sometimes he doesn't, right? So it is hard to beat the S&P 500, my friends. You cannot beat investing your money in something that tracks it because it will move up and down with the market. And as we all know, maybe we don't, but you do now, over time, over the long term, the market will always go up. Business will continue making profits. At least that's how it's been since we left the gold standard in 1930 when the stock market became a thing, okay? But effectively, patience and time equals wealth. So if you use the dollar cost averaging every single month for 30 years, you invest into the stock market every single month over 30 years, you will become likely a millionaire, but I know you will be wealthy, at least relative to your peers. And it's that simple. It's literally that simple. You build your income with building your skills. You cut and you manage your costs so you live below your means. You want to make sure you don't have any costly subscriptions that are going out of your pocket really for no reason. You want to buy assets and manage your liability. So when you buy assets, you want to make sure that you're purchasing them with zero liability attached, if at all possible, unless it's your home. And then number 4, when you have net free money every month, you're a net saver. You want to start investing into the S&P 500 or a mutual fund that tracks the S&P 500, and you want to use dollar cost averaging. Invest the same amount every single month, regardless of if the market is up or down. And I think in an ideal world, that would consistently go up, right? That would consistently go up. I mean, for me personally, outside of my 401k, I have an IRA, which is an individual retirement account, and I started at $50 a month when I opened this account, and I'm at $300 a month currently. So the best you can, once you start using dollar cost averaging, don't go backwards. Don't start investing $50 a month and go back to $25 unless you physically don't have a choice. You know, shit happens, life happens. But in an ideal world, you want to take that 50 to 75, 75 to 100, 100 to 125, 125 to 200, 200 to 300, 300 to 400, you know. And there are limits. I'm not going to get into limits in this video because this is just more for people trying to build their wealth very simply. So most of the people who see this video probably are not going to have to concern themselves with maximum limits on 401ks and IRAs. But there are limits, maximum limits per year. But yeah, I mean, it'll be that simple, my friends. And with some patience and, 25 to 30 years, you'll be wealthy or a millionaire. And it's pretty simple. You'll need vision, discipline, and consistency. Those are the 3 little skills that I listed in my little notepad. Vision, you're going to need the vision to know. A lot of people discredit this method because it takes so many years, right? So you're going to need the vision to know that following this method and in 25 to 30 years from now, you will very much appreciate the younger you for making these sacrifices and these decisions. There's an argument against this method that, like, hey, we might not even live that long. Why would I invest money for retirement or invest money for to become a millionaire 25 to 30 years from now? By the way, if you start this in your 20s, you'll be in your 50s, right? So it's really not some huge thing, right? So, but it's just interesting, people's short-sightedness. But they'll say, maybe I won't even live that long. And honestly, it's a valid point. Shit, maybe we won't. We're not guaranteed life. But the majority of us don't get our life cut short. Okay, it's freak accidents, for car accidents, for major sicknesses to happen. It's more likely that we make it to 50 years old, folks. Okay, it's just straight up more likely that we make it to 50 years old. And there are way too many 50-year-old people that are not prepared for retirement. They did not follow any of these methods, these steps, and some of them. I know someone in my personal life, folks, that is over 50 years old and has less than $15,000 in retirement. Your mind's blown, right? Like, it's going to be extremely difficult for them to survive in retirement. Straight up. Okay? And so it's going to take the vision to know that you're most likely going to live to 50, 60, 70 years old, and that these sacrifices and the discipline it took to execute on this plan will pay off for you, and you'll be comfortable. You won't have to concern yourself with the government Social Security check coming or not. You will have created your own check to live off of. You will have created tax-free income, effectively, if you put it in an IRA to live off of. Okay? Like, it's pretty nuts. And then discipline and consistency, right? So, of course, you're going to need the discipline to consistently learn to build your skills, you're going to need the discipline to always search and try to find and manage the costs that you don't need. You're going to need consistency using the dollar cost averaging method. So, you're going to have the thought, like every other human being. We use $200 as an example. The $200 every month that you're investing into the S&P 500, damn, I could take my family out to dinner. Damn, I'd sure love to have that nice t-shirt. Damn, I need this or I need that or blah, 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 blah. You'll find excuse after excuse after excuse in your own brain as to what you could do with that $200 besides using dollar cost averaging, sending it to the S&P 500 and letting it rock. It's going to take a lot of discipline, a lot more discipline than you realize listening to me talk right now if you're still here watching this video. And then consistency. Consistency is exactly what it sounds like. You're doing the same thing over time repeatedly, right? You have the same process. And that also falls back into the dollar cost averaging. Also, cutting cost, also going to be a big deal in whether you succeed on this method or not. So if you don't stay consistent with this, quote unquote, we could call it a simple path to wealth. And if you don't stay consistent in any other facet of your life, you will see it all go downhill, my friends. Consistency is a key to life and a key to success. To be all three of these words are a key to life and a key to success and a key to building a meaningful life, I would say, at least part of so. But there you have it, my friends. I know this was a simple video, not a lot of moving parts. I wasn't even going to use any visualization. I was just going to make a full screen video of me, but that's all right, my friends. We did it this way. That way you guys could read it off. No graphics, real simple. Let me know if you guys have any questions. And we'll see you guys in the next video. Peace, peace, peace.